So how is all this going on helping the markets and investing? How does it relate to that? Well, let's take a look at it. When we're talking about the financial speedometers again, the credit market, again, we're not worried about that. The Fed's going to do everything it needs to do. What we're more concerned about is the bond market and where the yield is. So when you're looking at this chart here, this chart is broken into two sides. On the left-hand side, you've got the average yields on the Treasury, government or corporate bonds and high yield bonds in the 90s. So average since 1990. On the opposite side, you have the current numbers. So let me talk a little bit about how these work. So from the Treasury side, what you're seeing is that the Treasury yield, average since 1990 was at 4.4. Now, how much was the premium you could get on top of that if you were in corporate bonds? Well, you picked up another 1.2. If you're in high yield, you picked up an additional 5.2. So in that, you could see a pretty good rate of return. But like we said before, we are now in a secular bear market for bonds. So where are the treasuries at this point? Well, they're sitting pretty low here at about a 0.6. Well, when you add the yield to corporate bonds, the 1.9, that's where we've been talking about a 2.5% yield out of the bond market. So if we're looking for a higher yield to be able to boost returns, we really have to go into the high yield corporate arena to do that. And that's where you'll potentially bring on an additional 6.5% in yield if the bond market is where we need to be. And that is one of the focuses right now from a tactical management standpoint with our portfolio managers. So ultimately, are we happy about the bond situation? Not really, not a whole lot you can do, but if you are tactical, you can actually squeeze out more yield without creating too much undue rest from a risk standpoint. So that's the bond market. When we move forward to the equities market, the speed dials, again, they really haven't changed much. The fear indicator is still in the red position. The valuations are still in a red position. Why is that? Well, again, it goes back to this chart again, and that is the chart of the S&P 500 forward pricing for your earnings ratio. So if you recall last week when we showed this chart, the earnings ratio for the S&P was about 22.33. Now it had jumped or had dropped down a little bit to 21.4. And you might say, well, why did that happen? Well, it's because of the market. The market actually last week had a bit of a retrace, and it looks like yesterday we were down again. But at the end of the day, the S&P 500 in one day fell 5.5%. So that's a pretty good drop. That's going to change the equation a little bit, and it certainly has. When you're looking at this chart, I want to point to a couple things. Number one, when we're talking about the strategies that we need to implement as we've got things set up in this fragile economy, this fragile market that we have, we're actually looking at an optimal place to pull the trigger on many of our strategies in this green area down here, which we'll call the optimal trading time. And what do I mean by that? Well, somewhere between the S&P's 2400 and 2600 mark would be an optimal place to start implementing our strategies. However, we do know what the numbers are showing us, and it's showing us that the downturn could be less. We're not exactly sure. We're following the data and watching how it's progressing here. So we've actually expanded the area that we could possibly pull the trigger on some of these strategies. So this blue area here is an additional area that we might very well be pulling the trigger on some of these strategies. What's the downside on this? Well, maybe we don't get as much of a return on that strategy as we would have gotten if we were in the green area. However, it still will be very beneficial. Let's go to the flip side of it. What if it just continues to move up? Well, the good news is we're still invested, so we're still participating in the market. It's kind of a win-win situation. It's a good place to be in. Whereas if it keeps going up, you see your accounts go up. If it comes down, you know we can execute at the right time. So we're feeling actually pretty good about where we are right now on that. We're just waiting for the right time. And again, as we spoke about before, if the market comes up and then ultimately comes down in earnings season, it might be the catalyst necessary for us to be able to pull the trigger at that point. So that's all good news. When you're looking at where do you invest these days, because we all know from a tactical standpoint, there are going to be winners and losers. And if you're tactically investing, we want to shift from sectors that aren't doing well to sectors that are doing well. So that's some of the things that our money managers are looking at. That's what we're looking at when we determine which portfolios to move to. In this chart, what it's showing is that realistically, looking out over time, 1, 3, 5, 10 years from now, we're looking at the U.S. market still being the place to invest from a weighting standpoint. This chart shows the black bars are the U.S. S&P 500, and then the blue bar is the MSCI Europe market. So it's basically a Europe index. And you can really tell in this that there is a great bias towards the U.S. market from a return standpoint. Now, if we look further, I'm going to talk a little bit with this one. We looked at this chart last week, and that is the rapid recovery that can happen when it's driven by the right policies. And right now, the market certainly is being driven by some good economic policies from the Fed and the Federal Reserve. So when we're looking at this chart, it shows October 82's market crash, the May to 2000 market crash, what type returns came on the S&P 54 days later, what type policy maneuvers were made by the Fed. And then in addition to that, the most important is this last part of the chart, which shows the 5-year returns preceding those recessions, and they're quite phenomenal. These are things that we're looking for moving forward. So even if the market doesn't retrace, which we believe it will, we still have a lot of running room in the next 3 to 5 years in the market. So we're feeling very comfortable there from a long-term standpoint. When you think about where the returns are really coming from now from a sector, in this chart, it shows you, large caps, core stocks, high dividend stocks, emerging markets. The first column here really represents how far the sector went down. The second one was the returns it made all the way up to March 2020. And then where we are as of June. So there has been a pretty sizable bounce back in the market. But again, how is it being driven? Why is it being driven? Well, it's being driven by the monetary policy, which has poured over $5 trillion into the economy. And what they're finding right now is many people who have extra money, and believe it or not, there's a large contingency of our population that are not spending a lot, so they're starting to save more. that money is going into the market, and that's helping prop it up right now as well. As the economy continues to rev up, I believe what you're going to see is a throttling back from the Feds, and more and more you're going to see a reduction in the amount that they're putting into the economy, and rightly so. You want to balance it out. As the natural economy moves up, you want to pull back on the stimulus. So good things happening right there. So let's go to the opportunities again, because again, we want to make sure everybody understands how these opportunities play into these type markets. So like Rocky said, we're focusing on the investment strategy and the wealth enhancement. So out of the 5 strategies that we have in our playbook here, last week we talked about the draw and let heal strategy. If anybody wants to go back and revisit it, it's on our YouTube page and you can take a look at that. This week we're going to focus on the strategy 1, which is active management reallocation of sectors. So this one's an extremely important one. It's been going on as this market has been evolving. But let's talk a little bit about how. First, let's go to the fundamentals, because fundamentally, when you think about what drives the returns in a portfolio, it has always been asset allocation decisions. That's 91% of what makes up the returns in a portfolio. From there, only 2% of is market timing. Then you got stock selection, and then you got other items. So the main focus is, where are we allocating the resources? So that's the biggest part here. And that's why in this environment that we're in today, tactical management is critical. If you are passively managing, again, you have winners and losers that come out of these type markets. And if you're passive, you're not going to take advantage of shifting sectors. But if you're tactical, you will absolutely be looking at the laggards, trying to get out of those, and then looking at the sectors that are moving forward. So let's kind of look at this. We looked at this chart earlier. We're going to bring it back again, because again, in a lot of the portfolios, we did have European positions in the portfolio, but many of the portfolio managers have already started pulling out of Europe investments and moving more towards the US. Again, tactically shifting the portfolio. And this is going to make a big difference moving forward for everybody. Same thing with emerging markets. When you look at emerging markets as a whole, the blue bars that we have here are really, they took a big hit. That's all of the emerging markets. When you look at strictly Asia from an emerging market standpoint, well, the returns here are looking better and better long term than aggregating all of the emerging markets. So you want to be more tactical, more specific as to where you want to be investing. And these, again, are things that the portfolio managers are doing. So some of the sectors that we're concerned with, well, travel related sectors, gas and oil, transportation, basic materials, real estate, those are all areas that got hit hard and are projected to have kind of a slow growth moving forward in the near future. What is now turned very bullish, and even in some cases was bullish prior to this, is things like communication, e-commerce, managed care, information technology is just skyrocketing right now. Business services, as you have a shift in the way businesses are going to perform and what type technology they're going to need in the days ahead. These are the areas that are moving forward. So tactical management isn't just going to stay in everything it was in before. It's going to make adjustments, and that is what's going to eke out a better return overall in our portfolios for our clients. So that has been going all along since this whole thing started. As you can see on this chart here, you've got the weightings of each one of the sectors from minimum, neutral to maximum. You can see no one's really overpumped until you get into the opportunistic income and even cash and cash equivalents. Those are more on the maximum side. Then you've got a lot of them kind of on the low side of neutral, like large cap stocks or investment grade bonds. And then minimum, you're looking at mid and small equities and also developed international equities. So we're looking at this, our portfolio managers are, as we're going through this whole process with our clients and with the markets. We are actually shifting many of the portfolios, especially if they're more conservative, over to more of a tactical nature portfolio through this process. So you can count on us to make sure that your portfolio is doing everything it's supposed to do, as well as the strategies are there to be implemented to make sure that you can get all you can get out of your money. So that is what we're here for. When you talk about where we are in the process with these strategies, last week we talked about the fact that we are right now paying taxes on any pre-crisis Roth conversions that we might have done. We are also, while the market is up, we're also paying up all of the life insurance premiums that might have been past due and now or are now due. We will pay the taxes on those as well as we do the conversions to the life insurance. So you will, if you're in that position, you'll more than likely get a phone call from our office letting you know that we're executing that for you. Again, actively working to make sure we got all we can get out of this market for you. Anyone that is in the draw and let heal strategy, we are not reversing anything at this point. We're still pulling the money out of the fixed accounts. So we will let you know when we have to shift back. But right now, remember, most of you have about 6 months worth of income that you're pulling from. So we still got some room, but we will keep you informed on what's going on with that. So that being said, so Rocky?
Okay, thanks, Dan. That was really good. There are a couple questions. The first being, you talked about unemployment. Are there any current projections for being back to full employment? What kind of time frame are we looking at there?
Okay, so full employment doesn't necessarily mean we're going to get back to that 3.4% level. Doesn't mean we won't. But from a definition standpoint, it doesn't necessarily mean it's back to that level. What they're projecting really is mid to late 2021 before we get back to that full employment level, which would be closer to a 4.5–5% level at that point. And certainly, if we continue to boost the economy and we don't have too many casualties from a business standpoint in that arena, if those casualties are low, the unemployment will go down even further. But if we have more and more bankruptcies relative to the small companies or companies as a whole, that's going to hinder getting back to the optimal that, let's say, President Trump would like to get to.
Okay, very good. Another question. Do you see Europe's growth? It's been lagging, it seems like, for quite a long time. Do they ever get back to, as far as we can see, equal status with the United States as far as growth and market growth and things like that?
Well, it's interesting. I mean, obviously, we've seen what the projected returns are. And the projected returns are all indicative of what type growth they feel is going to come out of each one of the sectors or economies out there. And we're just not seeing it coming out of Europe over the next, call it 3 to 5 years. They're going to be a little bit slower coming out of this whole thing from an economic standpoint than the U.S. is, and maybe even other countries. So it's unfortunate, but yeah, I think there is going to be a bit of a slowdown over there over other economies that are going to move a little bit faster.
Okay. Another question we've got is, do you think there will be more stimulus coming in the near future from the government?
Yeah, I think there will be, but it's going to be a little bit more targeted, and it's not going to be in such great numbers because, again, as the economy comes up, the stimulus should be reversing because the economy should be replacing the stimulus. So I do believe it's going to happen, but I believe it's going to be a little bit more targeted. Hopefully it won't be partisan, but that hasn't held up lately. But I do believe it's going to come, but not quite as strong as it was before.
Okay, very good. Let's see here, looking over, I think, well, there's one more question from Chuck. Is there going to be some type of notification to clients when the trigger is going to be pulled on those strategies that you discussed, that it's not quite the right time?
Yeah. So first of all, hi, Chuck. I can't wait to see you guys again in person. It'll be nice. And we'll talk a little bit about the reopening. But relative to when we pull the trigger, again, if I had to guesstimate, and again, with this market, that's the best anybody can do at this point. I would say there's a good possibility it will happen in mid to late July. But I think it also is going to require multiple triggers in the market for the market to retrace to a level we're comfortable with. In other words, should there actually be a spike in the COVID cases, we would expect that to be a drag on the market. If you have the earnings come in worse, or we'll call it worse than what we're anticipating, that would be another catalyst, and those two together might be enough to bring it down. And that really, it depends on how the news is portrayed. But we do know that things in the news tend to be a little bit overblown, and do create momentary glitches in the market. So I wish I could be able to tell you exactly when. To the other part of the question, will you be notified? Absolutely. As we're going through this process, clients will either be emailed or called to let them know that we're executing these strategies for you.
Good. Okay. One wants a speculative answer. Any crystal ball on what's going to happen with the presidential election? You want to take a stab at that? Or how potentially, with the COVID issues going on and the presidential election coming up, how is that going to impact the market?
Okay, so first of all, if I look down, I'm trying to stay off of any kind of landmines here, because everything is so volatile out there. But I would say this: first of all, in any election period, if you look at anybody who analyzes the polls start becoming really relevant 2 to 3 months out. Prior to that, there's just too much going on for those polls to be at all accurate. So it wouldn't really matter if the poll said, the president's up or the president's down from a projection standpoint, because there's just too much time. Anything can happen. So I'm not going to guess. It's beyond me. What I am hearing is this is going to be another real close one. And the reason is because there's a lot of people in the middle that are going to be making this decision. So you've got the left, they're not making the decision. The right, they're not making the decision. It's everybody in between that's going to do it. So it's up in the air. It'll probably be like last election where I'll be up at 2 o'clock in the morning looking for the final numbers, just like everybody else, because it'll be that close. Relative to what would happen, let's say if there's a flip in the presidency, every indicator, every economist, every manager that we're talking with is effectively thinking that it's going to be an immediate drag on the economy and the market because of the platform of raising taxes. They're expecting that to happen if there's a flip in the White House. So we would anticipate that if there is a switch, that there's going to be a lot of jockeying in the market where we will see a retracement a bit before people kind of get a feel of what the new administration would be doing.
Okay, so no more curveballs for today. It's the end of our questions. So I want to thank everybody for participating and asking questions. I want to thank Dan for presenting the great information today. And I think we're about ready to move on. I hope you guys have a great day. Thank you for joining us. And we look forward to seeing you on the next webinar. Goodbye, everybody.
Goodbye.